Hello traders! This is another lesson on technical analysis. This is intended to be the last lesson, so it's going to kind of lead into what we're going into next, which is going to be a couple of lessons on fundamental analysis. This lesson is going to be on time. To be more specific, we're going to talk about two specific points about time. When we talk about top-down trading, or down-top trading, inward-outward trading, basically using multiple time frames to verify your trade. The other thing we're going to talk about is cycles. Now, cycle is a really broad word for a lot of different things. Just look up Google cycles, time cycles, plus trading in Google, and you'll come up with more information than you could probably read in a lifetime. And there's so many books on it, but we're going to focus on a few that I use, a few different cycles that I'll use. And we are going to talk about top-down trading. So to start, what is top-down trading? Well, top-down trading is when, let's say, that, I used that a while ago. I haven't used MetaTrader for a minute, obviously. But anyway, top-down trading is when, let's say, you're looking at the 1 hour time frame, right? And you're looking for a setup. And let's say you're doing a trend following setup of this pound US dollar. And you're looking to get up on this uptrend. Say you saw it right here. So you got a 1, 2, 3, right? Like I spoke about in an earlier lesson. And you're looking to get in this uptrend. Well, you look for a trade setup right here. Say that you're trading support and resistance, and this is also a PTS setup, right? I showed that earlier in chart patterns. Do you want to take a look at that? But this is also a 1, 2 triple top or triple bottom, which is a reversal formation. A nice long shadow through the support. It's indicated. So if you say that you came across it right here, support, and you saw the shadow, and you're like, whoa, this looks like it might start going back in the up direction, which has been, pretty smart. What you do is you go down 2 time frames, and you look for confirmation. So do we look here? We have a hammer followed by another hammer, or inverted hammer, shooting star. Basically, shallow body, long shadow. So that's an indication at a lower time frame that we have a reversal. Another thing that you should do, actually, that I usually do, is I look for not only this reversal, but I look for this. I look for price to go up, and then price to come back down, but not go as low. Okay? See how price bounced right there? And I would probably buy it right here. If I was playing the hour time frame, I'd wait for price to not only bounce, which indicates it's forming an uptrend, but to break the previous high. And as soon as it broke the previous high, that is considered a buy signal. That is top-down trading. And usually you go down 2 time frames. Let's say that you're looking at the 15-minute time frame, and you look at this, and you're like, oh, uptrend starting. So now you go down to the 5-minute chart. And I gotta find it again, right? It's right here. So you go down the 5-minute chart, and you see there's a 1, 2, 3, and that you found a support level. And basically, once I saw that support had met right here, which kind of coincides with this ranging portion right here, then I look to buy as close as I could to that support level. Basically, what top-down trading does is it makes your entries better. and it gives you a second confirmation. It's an overlay, basically, and it's pretty important. You can also consider it inner or outward. Let's say that you were playing the 5-minute. You could do the other way around and see if it's down, bottom up, or outward analysis. So you've seen this, and you're looking, oh wow, this might be a great buy because you have this trend that's happening and it's going up, and it kind of broke the trend line, right? Which sucks, but let's see. I didn't actually trade, so I'm just looking to see how I might trade this. If I look at Fibonacci levels, see, and that's 50%. So that's 50% rule. I talked about this previously when I talked to PTS formation. 50% is a very awesome level, and it's easy to see it with Fibonacci levels. So what I would do then is move up and see where it lies. Ignore that now because it's time reference. And then you would see that there's a big hammer right there. It's basically this candle you're looking at. Is the tweezer tops, or tweezer bottoms rather, which is indication of a continuation or a reversal pattern, right? If that's what you're looking at. That's bottom up versus what we looked at earlier. When we looked at it right here, would be top down. Personally, I do bottom up trading because I am typically only in a trade for maybe 4 to 6 hours at the top. I try to avoid staying over in a trade because of fees associated with it, interest rates, and the simple volatility in the market. That's what I look for, unless I see a super long-term position. Like, say I was looking at a day chart, and for instance, if I was going to do top down, I do it at the beginning of my time. This is the only time I do top down. So look, see this Fibonacci level. Look, we have a 50% move. Close this candle on the 23rd, right? So what do we do then? We move down to the hour. Oh, this went way back because of what happened. Sorry, I don't want to move all the way forward because it will ruin what I was trying to show you. So, back to 23rd. Here it is. I would look for a formation right here on the hour chart that indicates that there's a reversal, but there really isn't one. I mean, there is tweezer tops, but that's all there was alone, and then those are succeeding this huge move up. Just kind of showed, no, that's not a good trade. So the downward look doesn't look so good, even though you're at a 50% Fibonacci level. Now, if this was a headed shoulders pattern or a double top, it's almost a double top, but not quite. It would look better. But that's how you use top-down trading. Now let's briefly talk about the other portion, which is cycles. Now, so this is a part that's crazy. There's 18-year cycles that people found, 9-year cycles, and it comes to trading patterns, especially in the stock market. But I don't go into those ones. The main thing that you should pay attention to are time of day. For instance, I wish I could show you this, but I only have printouts of it right now. But I have an activity chart, and basically it tells me when the market's the most active for each pair. Like, for instance, I'm looking at Euro US dollar right now, and it's most active about 9 o'clock GMT. So, given that information, if you want to make the most money, you would look for setups at that time. And then it's the least active about 2400 hours. Right at the end of the day. Do the same thing for the day of the week. When is your pair the most active? These are going to have to be, a way of doing this is called going to bathtub analysis. Take a chart and go one candlestick at a time and come up with your own hypothesis of when you think trends will change, what time trends will change. So you're in uptrend and you see retracement, try to look forward and see what time you think it'll change. Not only what price, but what time you think the trend will change. And also look for times a day where this happens, and look for times a day where there's the most volatility or the most action, that price is moving up as far as it can go. And also, if you're trying to follow a day chart and it's in an uptrend, and you're looking to get on, look at the time of day for the most volatility, and that way you can maybe find a good place for a good retracement. Other things to look for are expansion contraction cycles. This one I can kind of show you on a chart. So this is kind of a rangy market like we talked about in a previous lesson. But look, you have contraction right here, expansion, contraction, expansion, expansion, contraction. This is because of the reversal. But contraction, expansion, contraction, expansion. Now, this doesn't show the best example. I couldn't find one. I looked earlier. But if you give this from, let's say, from here to here. So count the squares on the chart. You can't really see this, but use your grids on your chart. I see some people that don't use your grids, but this is a great tool. So you have 1, 2, 3, 4, 5, 6 chart squares of contraction, and then 1.5, or just say 1 of expansion, then 1, 2, 3, 4 contraction, and then up. Count the squares. Sometimes there's a rhythm. Right there's not the greatest rhythm. But look at the time of the day too. This is between 18. Let's see, opening, closing. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. It's almost a full day, right? And then only a part of the day. I guess the thing you got to look at is a lot of times you're going to spend more time in a contraction or consolidation period and less time in expansion, and that's very prevalent right here. More time in a consolidation, less time in expansion. Even here, look. Consolidation, expansion, consolidation, expansion, consolidation, expansion. But again, consolidation period cycles are longer than the expansion part of the cycle. Okay, that is basics of cycles, and just be aware that they exist. There's expansion, contraction cycles. There's cycles in volatility. There's cycles in activity. Just do your own analysis and try to find rhythms with it. Try to find the time of day that this happens, that consolidation is breakout. Try to find a time of day that breakouts are likely to happen, time of day that reversals are going to happen. Mark them on your chart. Use horizontal lines on it. I have it all printed out, and I wish I could show you. I just don't have a scanner. But just know that they're important. You can find a lot of information out by just knowing what time it is. I've mentioned before, if you have a setup and it's right before a certain market opens, a lot of times right before a market opens, price will go in the opposite direction that it's going to open at. So if price is going down and you see a formation that's a reversal formation, and it's say a half an hour before like New York opens, it's a great time for a reversal. So that's a great overlay. Just be aware of that. The other thing in regards to time is be wary of when there's going to be economic reports or news. If you're not a news trader, stay away from those times. Don't trade during them, because they're going to increase the volatility and something might look great. You might have a triple top on top of a pivot point on top of a Fibonacci level, and you're like, yeah, this is a great freaking reversal formation, but then all of a sudden some data comes out and it's positive for the pair you're trading and just blows past it. That's the other thing you need to be wary of. Just, this is just a brief introduction to time. That's why I didn't spend a lot of time with it, and I looked for some brief examples. But in order to keep this at a basic level, I just went over it kind of briefly over a lot. I hope you found it enjoyable and good.